Thank you, baby. So, hello everyone. Hello, hello. My name is Adam. And how is everyone? How are you? So, here we go. All right. Just setting everything up on my desktop so that you can all see me. You should be able to see my camera. You should be able to hear me, and you should be able to see the charts in front. I think it's been a long, exciting day for you guys as well. Um, And what was I going to say to you? And of course, I'm just waking up. It's just like it's a lazy Sunday morning at home. So I apologize if that ends up throwing you guys a bit. But yeah, so let me just do all of this. Okay, and also one more thing I just quickly want to check with you, Sam. Um, Give me a second. Just see how everyone's doing. Cool. So let me just check something quickly. Yeah, okay, cool. Thank you. Okay, so let's do a quick run through of the market, but I want to show you the process, guys. I want to show you the process of scanning the markets as well, right? So in other words, I'm not just gonna do how you do it, but I'm gonna just break it down why I'm doing it in that particular order. Okay, so the first thing is, whether you know this or not, is that the US dollar is the biggest cog in the system. It's absolutely massive, right? So at the start of World War One, the British pound was the world's reserve currency, and the United Kingdom was the global leader. And then by the end of World War II, everybody was broke from fighting Hitler, and the US came in and kind of scooped up all the winnings and helped bail everyone out. So they all owed the US debts and stuff. And so by the end of World War II, the US possessed 95% of the world's wealth. And then the US dollar became the world's reserve currency. Now, it seems as though that's kind of changing at the moment, but that change could take 10, 20 years. Okay, so it looks as though the US is kind of potentially slowly but surely kind of on its way out. And there's a number of different possibilities. China could be taking over as the global leader, but there might also be the UK and EU might be strengthening again. So it's going to be very interesting to see over the next few years, over the next decade, how things kind of shift. That being said, the US dollar is still just, they are so big compared to everyone else. If you take China out of the mix, the US is bigger than the next eight countries' GDP combined. California is bigger than Japan. So one state in the US has, its GDP is greater than other countries, Japan and France, for example. So, excuse me. So the very first thing we want to do is we need to get an assessment of what is going on with the dollar. Is it trending up? Is it trending down? Or is it going sideways? All right. And just in case I've never said this to you before, because I know some of you know me, but some of you don't, there are only two states that any market, any time frame can exist in at one. It can only exist in one of two states at any one point, right? So it is either not moving, which is to say that it is mixing up its highs and lows, it is ranging, or it is moving, and it is either moving up or it's moving down. And those are two different states. They're not the same. It might be the same market, but the volume on this is lower. The volume here is lower. There's a lack of interest in it. It doesn't really know what it wants. It doesn't necessarily mean there's a battle going on. It might be in a coma. Whereas when it's actively moving, that means there's so much money in it that it's actually moving the markets, which means that a trend doesn't happen by accident. Okay. Now, the next thing you also need to know before we begin, oh, that's good, is that if you go from the monthly down to the weekly to the daily and below that, you have different types of money on each level. So on the highest level, guys, think about this. You've got pension funds and mutual funds going down to the weekly, monthly, or weekly. You've got hedge funds coming in and banks and institutions and private institutions down towards the daily. And they prefer to hold positions for longer periods of time and collect their management fees. So they really want to put the most money. They've got people's pensions and the bond markets and various other things. They're onto the longer periods of time. And then as you come down towards the daily and the weekly, you start to get The daily, you start to get swing traders and other types of institutions, some hedge fund activity, some banking activity, sure, where they're holding positions for, a few days to a few weeks. And then finally, right down at the bottom, you get day-to-day transactions. Tourists exchanging money when they go traveling abroad, parents sending money to their kids on a gap year, kids sending money to their parents from their remote job, day traders. You get a whole lot of activity. So you get layers of transactions on every different time frame. But what you need to understand is that as you go up the time frames, the money gets bigger and it's held for longer in the markets, like the carry trade and so on. And so what that means is that your time frame is kind of your direction is really set by what's going on from the top all the way down to the bottom. And so you need to understand that when trends are really strong, you've got people, day traders, and then swing traders, and then high net worth institutions, and then bigger institutions all agreeing, or at least all on the same side of the trade. So that at least starts to make sense to you guys that the higher time frame directs the lower time frame. The weekly tends to tell you where the daily is going to go. The daily tends to tell you where the intraday is going to go. Okay, does that make sense, guys? Yes or no? Okay, cool. So the first thing, so we're combining all of that. The first thing we're going to do is we don't have an access to the dollar index, but we're going to go look at euro dollar. So I'm just going to change my layout quickly. I think I'm going to go with, I just want to get to a single chart. I want to make it simpler for you guys. We'll just do it like this. We'll do this and we'll change the look and feel to let's do this one. Here we go. Nice and clean. So I say it's nice and clean. Let me just explain what you're looking at as well. The most important thing on your chart is price action, candlesticks. And it can be a little bit intimidating, but actually your brain is really good at picking it up. But it gets harder for your brain to pick it up if you layer a whole lot of stuff on top of your chart. Okay, it's hard for you to see what's going on. So I'm just going to explain what you're seeing here. Essentially, we're looking at candlesticks, which is our price action. Behind that, we have moving average geometry. Now I'm going to get rid of the 200. It's just a distraction. We don't need it for trading the way we're doing this. And the 50, 20, and 10 is moving average geometry. And when we see something like this, just quickly, when we see something like that, where we have the 50, the 20, and the 10 and price action all in that order, we normally have a nice established trend. When we see a section like this, where everything is on top of itself, then the market has no clear direction. It's medium term, shorter term, and current price action are all over the place. We don't really want to be trading when the market is doing this. Okay, you really want to be avoiding it. And then finally down at the bottom, just for double confirmation, I have two indicators that are doing the same thing for me. Now, this is very important. I'm not using these indicators for buy or sell signals. I'm not using these indicators for buy or sell signals. I'm using them to read the speed of the market. They're particularly good at doing that. So let me show you an example. Okay, let's do it like this. So if the market here has been traveling for a particularly, or actually we'll go back a little bit further because it's relevant to our analysis. You'll notice that the angle of the market changes. So if the market's going like this, if it's going sideways, it's going very slow. And obviously if it's going up very quickly, it's in a bit of a bubble. And if it's going down very quickly, then it's falling off a cliff. And somewhere in between, you have most trends operating. So here you'll see the market is going up at this angle, and then the angle changes. So what happens is it's very aggressive here, and then it kind of slows down, but it does still keep trending. But the speed changes. The speed changes. The speed here is slower than the speed here. And as a consequence, and as a result of that, you get what's called divergence. It's very subtle. I'm just going to show you here. So you'll notice that here you've got quite a bit of aggressiveness. And then because it goes slower here, because it's slower here than it was here, you get this falling behind. In other words, it's comparing the speed and the distance, comparing it to that. And so you get this difference, you get this divergence. And both of these are being used here because here you can see that this is slowly producing lower highs, but on here it was going up. Now, very quickly as well, Convergence is normal. So convergence is when the indicator is doing what price is doing, and that's what it's supposed to be doing. It's actually very normal. Let me just go show you a spot here. So for example, over here, you've got the market going up, producing higher highs, and here it's producing higher highs, and there it's producing higher highs, which it's supposed to be doing. But then it slows down. Over here, the market's not really going up as much anymore. It's going more sideways. And as a result, this starts to fall down. It starts to diverge away from price. Okay, and so that can be an early warning system that a correction is going to come, or a consolidation is going to come. I think that helps you. Now, I don't need both, not for today. I put two in because for beginner traders, it's helpful to have two as a double confirmation. You just want to make sure you're not imagining anything. So you look at both, and if they're both diverging, then it tells you that the market is slowing down. It can be an incredibly accurate, giving a heads up that the market is doing it. Okay, so now that I've explained everything on the chart, let's go ahead and start our analysis. We start off with the euro dollar because the euro is the biggest currency next to the US dollar. The first thing I want to show you is that the monthly, so we go up to the top helps give us a very nice high level overview. And some people think that, but why would I care about the monthly if I'm trading the 15 minutes? Well, here's the thing. The price distance that the market moves is not linearly correlated or not exactly correlated with the time frame. So if you go up to the monthly, it's not like it's, let me try something out. I've never actually asked the maths, but I'm going to do it now. How many 15 minutes? Okay, so what percent of that is 14 minutes? How many months? No, how many months in a 15 minutes? So, okay, so you get about 14 in a day. So you get 14, let's say times 30. Okay, so you get, let's just say approximately 420 15 minutes candles in a month. But the distance from in price is not 420 times as much. Okay. You might, for example, on euro dollar here, you will get from the high of this current range that we're looking at here to the bottom is about 300 pips. It's about 300 pips. So we go down to the bottom, it's about 1.14 to 1.8. So it's 400 pips. It's 400 pips. And you can actually, the euro dollar, if it wants to, it can move 400 pips in about 3 days. Okay, so the reason I'm telling you this is because sometimes people think that the monthly or weekly isn't relevant because they're trading the 15 minutes. And I'm saying it really is, because when you go up to the high time frame, you get a real sense of where the market is going. And the distance is not that far removed from the 15 minutes. In a really big day, the 15-minute can travel 150 pips, half this distance. So you kind of just make sure that in your brain that you understand that you still get value from this even if you don't trade it. So what we do notice when we look at this, guys, is that we have been stuck in a range. I want to get rid of you. Please go. We have been stuck in a range. There's our actual range over there. You can see the top of the range and the bottom of the range. If we go to the weekly, it'll start to make a little bit more sense. You could even, if you wanted to, you could tighten it out. Now, that started in April. It started over here in April last year. Can you guys, anyone who was trading in April last year, can you tell me what happened around the world in April last year in terms of trade? What happened in terms of trade that could impact all the countries' trade or currencies last year in April? I'll wait. I'll wait till someone tells me, till someone throws out a suggestion. Yes. All your answers are correct. Trump and tariffs. Okay. Now, very quickly, sorry, because I only get a little window with you guys and I have to brain dump as much as possible. So very quickly, the basic idea behind tariffs. It's a silly idea, but I want to explain where it comes from. If a company is not doing well, they normally get like a manager or a new CEO. And almost always the CEO comes in and goes, why are we spending money on all these suppliers? Can we not do this ourselves in-house? Can't we do this in-house? And they end up killing all the supplier contracts. And then they try to get their staff in-house to do the same thing to save money. That's the basic idea. That's where the thinking comes from. But the problem is with America, what they've done is over since Reagan in the 80s, they have actually chosen cheaper labor outside the US so that they could exploit that. They did that intentionally. And so they ended up sending that money out to China, who became very receptive to this. Good for them. And China decided to use that money to educate as many people as possible and to change its economy, to strengthen its economy. So now what's happening is, and not, America comes around and goes, hold on a second, other economies, if we want to do well, we need to stop sending money outside America. So we need to cut, we increase tariffs, which discourages buying stuff outside America and buying American. The problem is they haven't trained Americans to do it. It takes decades. All the specialist knowledge is in other countries. And they've ended up actually destroying themselves. And then the money that was being spent on investments on infrastructure in the US in the last administration, they've killed all those contracts. So basically, it's the dumb people in charge doing very, very silly things, just silly, silly stuff. Like it's ridiculous, and you can't do that. And the problem is because the tariffs keep getting put on and taken off and increased. Nobody in America wants to borrow money to start a business to create the service in America that is currently being done outside America, if next week the tariffs are just going to get taken away. So it's just gonna, you can see it's just destroying America. And one more historical thing, the 1929 stock crash. After that, for some reason, the same political party decided to impose what's called the Smoot-Hawley tariffs, which then contributed to a global depression. So it's not a good idea. It's never been a good idea, but I wanted to explain to you guys the psychology behind it. Okay. But I'm very interested and very optimistic about what's going on at the moment. So let's get back to the charts. I hope you guys are enjoying what I'm telling you. I hope you're finding it useful. So long story short, you are seeing the markets ranging because they're kind of a little bit uncertain about what's going on. And here's what happens. Initially, let's just say that you had a pretty good relationship with someone. And then for some reason, they went a little bit kind of nuts. At first, what you would do is you wouldn't want to bin the relationship. If you were Europe or even China or wherever, you wouldn't want to bin the relationship immediately. You would keep hoping that the person, America, would come back to its senses. But it's pretty clear now that that's probably not going to happen. And so much damage has been done in the relationship that now what's happening is outside. Oh, good, good. Is that, oh, that makes my, that, thank you, that makes my day. Um, is that outside the US, countries are now starting to look for trade deals with each other. But it takes time. It takes time, right? Because it's a huge, like everybody's economies are so big and it takes a long time to rewire all of it. But it's a good thing. This is a very cool thing. So anyway, euro dollar has been ranging and really it's going to keep doing that until at some point some kind of clarity comes back to the market. But what does this mean for actual day traders or traders, swing traders? Okay, so day trading is trading on the lower time frames, the 1 hour, 30 minute, 15 minutes. Swing trading is trading on the daily and upwards. What about the 4 hour? Well, the 4 hour's got its foot in swing trading, 1 foot in swing trading, and 1 foot in day trading. Why is that? Because when you take a trade on the 4 hour, there's a really good chance that that position will be open overnight. It's almost always going to roll over to the next day, which means it's kind of higher time frame trading. Okay, so um, so what does this actually mean for us? It first of all explains the choppiness. It explains why when you're in a range and it doesn't really have much direction, it explains why you might suddenly get a bit of a trend and then the trend just goes away. So this is what the monthly and weekly helps us realize is like, oh, actually this is where price is stuck. And it's not just that, but that's what's going on and that's why it's being caused that way. And at some point we could see it break out to the upside or to the downside. And one really, you guys should write down stuff as well that I tell you. Um, Only because unless you get a recording of this, you get access to a recording of this. But here's the thing. The thing with ranges is you're in the range until you break out, meaning that even if it surges to the bottom of the range in one day, I've seen it stop and you're like, oh, it's definitely going to break out. And I've seen it stop and then just go the other way. So you really should never assume it's going to break out the range until you actually see it break out the range. Okay. And that doesn't matter. That's for all trading anyway. So the point is we're stuck in a range for now for the foreseeable future. Let's have a look at GBP USD. So what does that actually mean? It means that if you're trading euro dollar, guys, Be aware of where the outside levels are because if you're heading towards them, the market will probably go towards it, but also make sure you take profit ahead of those levels. All your profit levels have got to be easy for the market to reach. It has to be. You don't want to you wouldn't put a profit target here because you're still stuck in the range. So you always want to make sure that your profit target is on this side of whatever the obstacle is going to be. And it's tough. If that's only going to make you 0.5%, but you're still going to take the trade, that's fine. But at least you understand this is why I have to get out the trade. This is why I have to close the trade here because there's a price barrier that we're not going to get past. So always remember, you want as much as possible between the market and your stop loss. And you want as much as possible, you want as little as possible between your target and you, which means you want your stop loss outside the range, but you want your target inside the range. Okay, cool. Guys, trading is a logical, rational behavior. Okay, it is. It's not just thumb sucking. That being said, let's go to GBP USD. Now, as a general rule, I don't like trading ranges. I used to. I know how to counter trade. I know how to range trade. I learned all those strategies. I prefer to go through all the markets and then only trade the ones that are trending because they generally are the safest and they offer fewer losses and the most profit. Okay. So GBP USD, again, from a monthly perspective, guys, they're all in a range. I'm just going to save you time. They're just all stuck in a range. Same thing. So when you go to the weekly, if you're wondering why it starts trending and then just loses the trend, it's because it's in a range. Okay. So right now, long story short, this tells us that the dollar is actually ranging. The dollar's not going anywhere. And this is mostly in currency markets. So what it means is that trading any of these, any of the majors, is a bit hit and miss, because the dollar is normally so big, the dollar is moving up or down and it creates these trends. And this is it. So when you see movements like this, it's almost always the dollar that's actually doing that. The US dollar is the bigger part. Um, anyway, so you could see here that the Aussie dollar has actually been strengthening quite a bit, but also the last, few weeks it's not going anywhere. If we look at Kiwi dollar was actually weakening, and also the last 4 or 5 weeks it's not going anywhere. So please, when you are trading anything against the dollar, just remind yourself that you're not going to get long sustained moves on it. Okay, it'll move a bit and then pull back. So you really want to trade them more defensively. Take profits sooner rather than later, or don't trade it at all. Now, one exception to that is the Bank of Japan, and it's coming up to a key level. So it's a little bit of an exception to that. Now, can I give you a quick explanation as to why? It's very interesting. It's very cool. So if you look at all the yen pairs, if you just bring them in, you will see that the yen pairs are doing quite a bit of movement. I can't remember what this is about. I don't know what the red line, I forget why I put it in. But if you look at, you can see that all the yen pairs are going to the upside. So the yen has been weakening. It's really interesting, actually. Again, Japan decided to look at very clever, decided to look what's the strongest economy in the world, the US economy, and then decided to build their economy around that. They like structured around that. So one of the things they used to do is the currency's been weakening over time. So all the currencies are going up against the Japanese yen, it's been weakening. But also they kept interest rates very low, like zero. Like originally they kept them at zero. And the problem with that is that all the citizens eventually became very comfortable with very low interest rates. And it becomes a problem because at some point you're going to have to raise interest rates. And when you do that, if your whole lifestyle is dependent on low interest rates, your lifestyle is going to get very expensive very quickly. So externally, here's the other thing, and this is actually amazing. Historically, the three most stable currencies used to be the US dollar up until Trump, the Swiss franc, and the Japanese yen. Very stable because just the policies never really seemed to change, and so it was very reliable. And so what happened was because Japan's interest rate was 0%, what happened is that big institutions, big banks all around the world, outside Japan, would borrow Japanese yen at low interest rates, convert it into US dollars, and throw it into the stock market. This is actually fascinating. If you didn't know this, this is incredible. So borrow money, it's very cheap to borrow because the interest rates are like 0.5%. So borrow it, throw it into the stock market, right? Into the US stock market. So converts it into US dollars. And so what happens is if you make 10 or 12 or 15% on the money you borrowed, you only have to pay back like 0.5%. So it's like free money. And so big institutions have been doing this. So that means that a massive amounts of the US stock market, which impacts the global stock market, is leaning on the low interest rates of the Japanese yen. And if they increase those interest rates, they're going to probably, this is normally what happens, they'll probably start closing out those positions because they've got to pay back the Japanese yen and they don't want to borrow money if the interest rate is too high. So now what happens is outside Japan, Japan is under pressure. If we increase our rates too much, the global stock markets will actually start to fall because everyone will have to pay back their Japanese yen. And internally, our citizens, things will get too expensive for them. So this is the crisis that you're seeing unfold with the Japanese yen. They actually don't want it to go where it is now. They want it to come down a little bit, but people, they're going to impact the global markets. It's amazing because I don't think that was their plan at all. So I want to explain though, it does tell you if you're trying to understand what the difficulty is that the Bank of Japan is going through, that's what it is. They actually do need to raise interest rates. They do have to do that. When you raise interest rates, your currency gets stronger. So they have to raise interest rates to strengthen their currency because it's getting a little bit too weak. And because they do exports, it impacts their economy. So they're really stuck between a rock and a hard place. So they're just going to have to do that. But it does explain to you why they can't do it too fast and they have to do it very slowly. Okay. But all of the yen pairs continue to go up, guys. So for now, until they resolve that issue, it's very likely that the yen pairs will continue to very slowly start to head to the upside. And this is part of the reason it's kind of on my watch list, but for now it also looks like it's slowing down. So again, here you will see market goes up, now it's going sideways. It's kind of lost its trend. Okay, so I would love to say to you guys that the yen pairs should be on your watch list for this coming week, but actually it looks as though they're kind of taking a bit of a breather right now. And again, here's where you start to, well, I won't see it on that one. Let's see, CAD Gen also going up. Now it's going sideways, just so you can see it. That is now going sideways, but prior to that, it was going up. Okay, so that means prior to that, it was kind of up like this. Even if you don't put your trend line there and you put it there, I think we're pretty much going to breach it. So it doesn't really matter. We're going to break through it. So the yen pairs were really some of the best trends that we've seen over there. The dollar right now is not offering a lot of clarity. If we have a look at dollar Swissy, it's completely messy and choppy range bound. Dollar CAD goes in an uptrend, then goes down, now it's going up. It doesn't really have a trend just yet. It's just swinging wildly. When you go to the weekly, it's not really looking that great. And when you go to the monthly, you can see it's actually range bound. It means it's stuck in all those bits there. So just be aware, guys. Okay, if I'm trading anything on the dollar, like I've got to make sure that I take my money sooner rather than later. Dollar Sing as well is also in a similar type of thing. It's slowly going down. You can see the 50, 20, and 10 fanning out. You can see lower highs. You can also see we've started to break through here. So it is going down. But then when you look a little bit closer, it's not done anything. It's going up and down and up and down. So if you reviewed your trades up going back to April last year, you should find, and I mean this for everybody, not just for you guys, but for Paul and myself and Chloe and everybody. We had a massive, I had the highest number of losing trades in April and May last year, and then a little bit in June, and then the market started to move a bit, and then there was some money making, but the tariffs really kind of messed with the currency markets weirdly, more than anything else. So let's have a look at gold. So of course, gold is on fire right now. It is very much overextended. So what do I mean by that? I mean that the market goes through extension, pullback, extension, pullback, extension, pullback. Okay, on the way down, it's extension, pullback, extension, pullback, extension, pullback. But sometimes it does a very extreme move. Okay, so it'll go like this, extension, pullback, extension, pullback, and then it does this. And so that's very overextended. So if you look, you can see how this has not even come back to the moving averages like in a very, very long time. So it's heavily overextended. Why is it overextended? Actually, it's weird, but for once it makes sense. Sometimes, a lot of the times, there's no real reason why the market does anything. But if we go back here, we can see that the last time, I'm trying to get the exact right scale to illustrate this point. But over here, for example, down here, suppose we can go this way and go back. Here we go. This period over here, where it hits $1,000 an ounce. Sorry, I was going to say $1,000 an ounce. Over here, this period where it hit $1,000 an ounce was during 2007 to 2009, global financial crisis. Think about it. All the markets are uncertain, all the markets are crashing, everything is going nuts. And so there's this increase, this move towards gold as a safety. Okay, so while all the global financial markets are melting down, gold starts hitting $1,000 an ounce and ultimately breaks through. And then it goes on a tear until 2011 in a bubble. And eventually the bubble bursts and it comes almost all the way back, almost gives back almost all of those gains. And that's in 18 months this way, and then about another 2 years this way. And then everybody forgets about it. Everybody forgets about it for quite a long time, stays trapped below 1360. Eventually it breaks out in 2019. What does it do then? Then it goes back into another range over here from 2020 until 2024. And then it breaks out, and this is where we are now. So a couple of things I want you to take away from that. Gold goes through these bubbles and then bubble bursting phases, and then people forget about it and nobody cares about it. In the past, the last time it was going up like this was because of global uncertainty. We have the most global uncertainty that we've had since World War II. All right, it's pretty clear that America is increasing its aggression now, probably wants like it's what's called like a death rattle kind of thing, where it's on some levels of where it's dying and it's losing power. So it's attempted to try one last surge to regain or hold on to power by invading other countries for resources. And it's not fighting the enemies, the tougher people. It's fighting the weaker countries. What I mean is it's fighting its allies. Invade Canada, invade Venezuela, go for Greenland because they would resist less and they can capture the resources with less of a fight. That's what it thinks. That's what it thinks. But it's not going to go that way. Just showing you, it's not going to go that way. But if you're thinking there's no way the US would invade Canada, I'm like, yeah, just wait. It's not off the table. So my point is this, is that is why you're seeing this rise in gold and silver. And I can't really see I can't really see it really bursting until that a bit of certainty comes back to the world. So I think it's going to continue to go up, but that also means you might have 2, 3 months, 3 or 4 months where it kind of takes a bit of a breather. So we might have a couple of months this year where it comes back down, but I think that the overall trend is going to stay in place until some certainty comes back. Silver has obviously now joined the race. So know this, the two of them are in a bubble. They are in a bubble, but the bubble over the next year or until certainty returns can keep going up, but there could be a few weeks here and there where it loses its trend and comes back down. So on one hand, I want to say to you that the trend is quite strong and probably quite secure. It's gonna be kind of bulletproof until it isn't, meaning that the things that are driving it to the upside are are not, as long as they are still a threat or increasing in uncertainty. I think that gold and silver, you're going to see money move out of US dollars because they don't know what's going to happen with the US dollars into gold, and it's going to keep going up. We will have periods where it corrects like this. We will have periods like that. But here's the danger. In situations like that, ladies and gentlemen, you're never supposed to trade without a stop loss. You're never supposed to trade without a stop loss. I know that. You know that. But sometimes people get in a situation like this and they go, oh, Adam said it's bulletproof. I'm going to buy and I'm not going to have a stop loss on. And then that bubble bursts and then it loses all of its value and the person's account gets wiped out. So I'm just trying to say something. I'm going, on one hand, I want to say to you that this is probably one of the strongest trends out there. But when there's going to be a day when it's going to do its last move to the upside and it's going to come down. And you don't want to be stuck in that account or that trade when that happens, which means that it's almost cool. It's almost more important than any other trade that if you're trading gold or silver right now, which is in a bubble, that you have that stop loss in. I don't really care where you put it, but you've got to have a point before you get into the trade. You go, look, if it gets here, I am out. And don't increase your risk. Keep your risk at 1% maximum so that if you do happen to get the very, very last trade, the worst thing that happens to you is you lose 1%. Because then, you know what, and if that bubble's bursting, then you can make the money back up on the way down. But the last thing you ever want, because it'll break you probably semi-permanently, is to get caught in this when that bubble does burst. So just promise yourself, don't promise me, promise yourself that you will never get into a trade of gold and silver while it is still in a bubble without that parachute that will extract you from the situation if it does, if you happen to be in it, and that could be 6 months from now. but it's just so critical that you understand that while the trend is strong, there's gonna be a day when it just vanishes and you just don't want to be in it. Okay. This is interesting. Val, so Val's question is the volatility index correlated to precious metals like gold and silver? That's actually a great question. So the VIX traditionally measures the S&P, predominantly the S&P. And so it's really more if it would only, be influenced by whatever gold mining companies and other various stuff that would be in there. So it's not strictly doing that. But what it does do is it shows you the rotation of money. So what that means is that if the big money and institutions start panicking and they start moving their money out of stocks and moving it into commodities and various other things, yes, it would show up in the VIX. The VIX it's useful, but it's not actually super, super amazingly useful. All it really does is tell you if it's like a heart rate, and it's like if it's flat, the market's calm, and if it spikes, the market's not calm. And that's all you can really, really get out of it. Such a great question, though, guys. Um, Okay, guys. So gold and silver producing some of the best trends right now. Silver is this has gone parabolic. So parabolic, just in case anyone hasn't mentioned it to you, is that angle has gone almost straight up. When it goes straight up, at some point when it bursts, the drop is almost straight down. So in other words, the faster it goes up, eventually the correction is usually quite strong. And I want to finish off with one more thing to really drive this home. I want to show you 100 years worth of gold behavior. 100 years worth of stuff. So from 1935 to 1975, gold hardly moved. It was regulated. They regulated the price in the US because they didn't want to lose value against the dollar. Then they disconnected it, okay, from, I think it was Nixon, disconnected it from the US dollar and it surged up here. So in 10 years, it surged upwards. But then what happened? From 1980 to 2000, 20 years, it lost value. It lost value, went down over 20 years. And then it surged up to 2011, which was the last bubble we had over here. And the last part was a bubble. And then it dropped down for like 9 years. And then it is where we are now. So what I want you to take away from this, I want you to understand, it's not like everything gold will come all the way back down, but I think it can have very strong corrections. And here's the thing, right? If you were a vampire and you could live for a century, yeah, you're always going to make money on gold. But if you decided today, I'm going to put money into gold now, I'm going to hold it for 5 years, or 10 years, you could find in 10 years' time, it's just always lost value. So I kind of think that it's okay to have a little bit of gold in your portfolio, but I wouldn't go all in on it. And also I would, as a trader, I would monitor that. I need you guys to understand that gold can go for 10 years, go down for 10 years. So it is very possible that once we get to the next point of peace, that it'll be so overpriced and the danger's gone away, no one will be interested in it. No one will care. They're like, we don't care anymore. And it'll just lose value for like 10 years. So just think, it's happened throughout, the last 100 years. Just be aware of that. Okay, but that being said, these two are offering the strongest trends right now. So I kind of want to say to you, cautiously trade them as long as these trends stay in place, because they could be there for 3 months, another year and a half. I think we'll have corrective periods. Like here, there was like 3 months where gold did nothing. Okay, 3 months where it did nothing. But then after it took a breather and a rest, it went up. And then it did like 1.5 months before of taking, excuse me, for taking a rest. And now it's taking a bit of a rest. Now it's going up. And then finally, so the yen pairs are good. You'll notice again, there's patterns that you don't always notice until you see them. The Swissy pairs. So if you look again, remember the Swissy is a relatively strong currency. But if you zoom out on the longer term, this is a monthly chart. You can see that it keeps going down. So Euro Swissy is going down, Pound Swissy is going down, Aussie Swissy is going down, Kiwi Swissy is going down, and CAD Swissy is going down. So this is the opposite of the yen pairs. The yen pairs are going up, Swissy pairs are going down. Why? The Swiss franc is strengthening because they're quite stable and they're not in the same position as Japan. So Japan and Swiss franc, but Swiss franc right now. And also, they're not going to want their currency to get too strong because they're also an export country. So if they become too expensive, they can't really do that. So they have another problem. And so what you'll see is, and it's a bit frustrating because we know where it's going in the long run, but when you get down to the lower time frames, it becomes incredibly choppy. So that's your monthly chart. Then you go to your weekly chart and look at this. You can't trade this. So again, I want you guys to just little notes. The yen pairs you should be trading, but just be aware of their situation where they do eventually want to change the uptrend to a downtrend. The Swissy pairs are, we know where they're going, but they're incredibly dangerous to trade because even though we can see where they're going, they're just so choppy and messy. Um, the dollar pairs, which can produce some great trends, but the reason they're not doing it right now is because of the tariffs. And then gold and silver are looking the most attractive. Okay. Crude oil is also a little bit funny as well. So if we're going to have a look at crude oil, that's also kind of slowly but surely coming down. It's got a bit of a level here. And then if we have a look at it on the daily, it kind of doesn't have much trend. And I think that's because the speculators have kind of faded. Sam, I just want to quickly do the global markets and then we can wrap up. So the US, the Dow. Okay. Oh, actually, this part's really important. Sam, I want to kind of do this quickly. Because I want very quick question. Um, we're not saying, listen, if I say the market's in a bull market now, I'm not saying we can't have a crash. The US jobs data and the US data is looking worse and worse and worse. But I want you to understand something. The stock market is essentially made up of spare cash. It's made up of wealthy people's money. It's not representative of the economy. Because when you're investing, you're taking money that you don't need right now and you're putting it into that. Like you'd put it into property, you're putting it away for a while. But normally it's because you don't need it. Then on top of that, you add all the rich people tax cuts and all the corporation tax cuts that the US got, and they're putting all their money into the US markets, combined with maybe borrowing the yen and stuff. And that's where the wealthy are really making most of their money at the moment. And they don't really want to stop doing that. If they could, they would have further tax cuts if they could. And so this, I want you to understand why the markets keep going up, even if the economies aren't doing well, even if wars breaking out, which is how you know you're in a bubble. If the US bombs Iran and then the next week invades Venezuela and the market just keeps going up and it isn't bothered by that. Guys, that's not normal. In the past, if the president of the US coughed or said the wrong word, the markets would tank. Now nothing is stopping them. And I want you to understand why that is. Because right now it's definitely in a bubble. It's definitely disassociated. And it's kind of like the Titanic is sinking and all the rich people are quickly stealing as much of the silver and everything as they can because they think they've got their own lifeboats. So they're not, they're not really worried. So that's kind of what's happening here. But there's a disconnect between the markets and this. Plus, you've got excitement about AI and various things. But there's a lot of data that's actually looking really bad. There's a couple of banks being bailed out, companies going bankrupt, the tariffs aren't helping. And eventually what will happen is it'll be unsustainable. So we're not saying, well, if I say to you the market's bullish, I'm not saying to you that there aren't problems and maybe we're not in a bubble and that bubble isn't going to burst and it's going to be quite bad. What I'm saying is we're still in a bubble, meaning that there's still shorter term opportunities. We know there's danger up ahead, but there's potentially still time to. This is really important, guys, because our beliefs impact our ability to trade properly. And if you have a belief, this market's supposed to be crashing, why isn't it crashing? And you keep shorting the market, even though it keeps going up, that's your belief overriding your logic. So the price action is always the truth. If the market's going up and you think it should be going down, you're wrong. Like as a trader, you're wrong. So you need to always be going with the market until the market agrees with you. But in order for the market to go into a bear thing, this is the biggest wisdom lesson I can teach you guys. This is hugely important. We're going to go back here. There's almost always a warning. Okay. Weekly chart, first rule, weekly chart. Second rule, 50 period. Doesn't matter if it's SMA or exponential. Simple works fine. So what happens is, here's the basic rule of thumb. I'm going to teach you this. This is some proprietary knowledge. But generally speaking, if your weekly chart is in an uptrend, meaning a low and a high and a high low and a high high, and it's above the 50, it doesn't matter where that 50 is. It doesn't matter if the 50 is there or there or there or there, but you've got both of those things happening. Price is above the 50 and you've got an uptrend on your weekly. You're in a bull market. Okay, you're in a bull market. So what you want to do is you really want to pay attention only when price drops and closes below the 50 on the weekly. It takes a long time, guys. It takes 6 to 8 weeks to maybe even another 12 weeks. I mean, 12 weeks in total before that happens. So this is the first thing. Here we get a big drop and it's quick. It's very quick. That's an unexpected market event. That's not a market. Everyone's expecting the market to drop now. So it's not going to be unexpected now. This is COVID. Comes out of nowhere, no immediate solution. What do we do? Panic, and it drops quickly. But otherwise, you get your market corrections. So if you go back here, this is actually a bear market. This is when the inflation got out of control in 2021 after COVID, and then the US had to raise rates, which means borrowing became really expensive. And so they started to close out their positions in the stock market. And so we went into a bear market. Then the inflation got under control and they started to cut rates. Then the markets started to, then money started going back into the stock market. And so it starts recovering. So this part is slower. You can see the turn. But here's what I want to show you guys is that when you're looking at your lows on the weekly chart, that's really what you want to be watching. Because when you break a big low on the weekly, that should be your, okay, well, something's changed. We're not in a bull market, or I need to be careful. So for example, here, we broke through that support. It happened really quickly. And then it dropped and closed below the 50. And obviously COVID came out. So that was the story there. But what we want to be watching is something more like this. Here you can see a couple of things. You can see the market going up and going sideways. And if you drew, it didn't matter where you drew your line. If you did it there, or if you went, actually should it be there? And then you're like, you know what, I'm just going to do it here. The moment it starts to really breach that level, then, and it's below the 50. Now it's underneath the 50, boom, you're in a bear market. So that's going to be the earliest. The weekly will be your earliest warning sign that that bubble that we're currently in is possibly starting to burst. So taking all of that into account, okay, look at where we are now. Look at where we are now. Our 50 is over here. We're producing higher lows, higher highs, and our 50, 20, and 10 all fanning out. Okay, the second thing I'm going to show you is amazing. This is what's known as a V-shaped recovery. Big drop, big move. And they pumped a whole lot of money into the system. And as a result, you got this V-shaped recovery and then a subsequent surge up there, this is the one, which lasted from, let's just say, from the very bottom of that point, just to give you a time estimate, to the point at which it's really started to crack until it was done, which lasted from March 2020 until January 2022. So let's call it December, January here, okay? And so that's almost, sorry, 2022. So it's almost 2 years, okay? Just under 2 years, 18 months. Cool, check this out. V-shaped recovery, okay? V-shaped recovery. If we start here and we go 2 years, just to say, so what's that? That's actually not March, that's April. So we could go through, just go a little bit further. So that would be February 27. Is that right? Yeah, I think so. If we do that, let's just zoom out, make sure it's right. So that distance from there to there, roughly from there to there. January, let's call it December, January, February 2027. If it does exactly the same thing, big move up there. So there's your drop and a move up, drop and a move up. They just got all their massive tax cuts in June last year. They don't really want to quit the market. And right now, companies, as long as companies keep producing record earnings because of, what they do, it's going to keep going. So this is going to go until you get the following. Until the cracks are impossible to ignore. So company earnings keep getting missed by lots of companies 2 or 3 quarters in a row, which, because they only report quarterly earnings obviously every quarter, and it has to start to appear it's not just one company failing, it's a lot of them. Then they're going to start to get nervous and start moving their money around. But even then, the US will try to cut rates to juice the market and print money. So they haven't really even started juicing the market to keep it going. And you must understand they just got their tax cut. So the wealthy people are really going to, and the companies they want to keep this going as long as possible. We don't really know the truth of AI yet. It's going to definitely be in our lives going forward, but we don't know the degree yet. So it's still a new thing. So we're still figuring that out. So all I'm saying to you guys is we're in January 2026. Think how fast this year goes by. All I'm saying to you is that it's possible that this bull run will carry on towards the end of the year. It's gonna go by like this, and over that time, the news will continue to get worse, and and eventually we'll start to see it maybe slow down a bit, and you'll get your warning signs. And again, what you'll do then is you will monitor the weekly lows. So you will keep monitoring this low. And then when you get another low, you'll put it there and you'll get another low. So that eventually when price does drop through it, you'll be like, okay, I think this is it. I think the market's starting to roll over. If we get something unexpected like a COVID resurgence or not even COVID, but maybe bird flu, something really unexpected, then yeah, maybe we'll see a bigger drop. But that's what I want you guys to monitor. But taking that into account as we wrap up today's session, okay? Until we wrap up today's session, this is what I want you to look at the markets. Look at the strength of that uptrend. Look and see how it's going. This is a weekly chart. Look at the S&P. Okay, it's starting to slow down a little bit, but we'll see. Look at US tech as actually, this is actually an ascending triangle. So it's actually an ascending triangle. It's probably going to break out. Look at the FTSE. Look at that. It's having its best run ever. Look at the German market, consolidated for 7 months, took a breather for 7 months, breaking up to new highs. Look at this moving average geometry. Look at the quality of this trend. Look at the Nikkei is having its best run ever. And so what's happening is because the US is destroying all its trade relationships, other economies, other stock markets are actually doing well. People are moving away from the US markets and moving money into other stock markets. Even the Hang Seng, which has been the weakest performer of the whole bunch since 2018 going down, it's now in an uptrend. Okay, so it's now breaking to the upside and trending up, and the 50, 20, and 10 in a bullish formation. MACD's above zero, all this stuff going, and finally, Australia pulling back and heading off. Okay, so long story short, we're wrapping up, guys. We are very much in a global bull market. The non-US indices are doing even better than the US indices. Currency markets, dollar is still stuck in that range. Keep an eye on it. The Swiss C pairs I wouldn't trade, even though we know where they're going. The yen pairs I would keep an eye on. Gold and silver look amazing. So it's a very small pool of things to trade, but it's the best that's on offer right now. So I hope you guys enjoyed that, and I hope that that really gave you some direction until the next Sunday morning. I'll see you guys in, I don't know, three months or whenever Sam gets me on board to do it again. But I'm going to let you go, and I hope you enjoyed this, and I always enjoyed it. It was